retained earnings. This will wrap up chapter 18, talk a little bit about different types of dividends, and I'll do a couple of brief exercises for you all so that you can go ahead and proceed with the graded homework for chapter 18. So retained earnings, as we've talked a little bit about it here and there, we're devoting a little bit more time to just specifically talking about retained earnings. But as I mentioned, it represents the corporation's undistributed net income, and if it's negative, it's a loss. We don't like that. That's not good. But it represents the money that the corporation has not distributed. And so you want it to have a credit balance because that indicates a dollar amount that's been previously earned. That's a positive number, but not distributed. The debit balance would indicate a deficit and or a negative balance, which I've said several times is really not a good sign for a company, right? So, and that doesn't mean that a company is necessarily going to go out of business, but it's certainly a sign of some problems. All right, so what do we do with that retained earnings? Well, we use it to, in some cases, pay out a dividend or distribute a dividend. And I think by now everybody understands that a dividend is a distribution of cash or some other asset, which we'll talk about. And it's a return on investment to the shareholder. And that's exactly what it is. It's money earned by the company, and they're returning to shareholders a portion of their investments because the company wouldn't have been able to make that money without the assistance or the aid of shareholders. A liquidating dividend is a dividend that exceeds the balance in retained earnings, and that's also not necessarily a great sign. But what we do with dividends is we pull the amount of available money out of retained earnings. If we have a situation where we're liquidating more than what's available in retained earnings, then we have to reduce additional paid-in capital for the excess money. That should not be happening, though, under normal circumstances anyway. There can be restrictions to retained earning. It's almost like, if you have a savings account and you have set certain money aside not to be spent for anything other than what you've designated those funds for, like a down payment on a house or something like that. It's kind of like that. Any kind of restricted retained earnings is not available for being distributed as dividends. You have to disclose the information in the notes to the financial statements. And there can be, but it's quite rare, where you actually do a journal entry where you pull out a certain amount or that specific amount out of retained earnings and you put it into another account called appropriated retained earnings. Normally we don't do that. I mean, I've seen it done before, but the disclosure note should be sufficient. And a restriction of retained earnings communicates management's intention to withhold assets represented by a specified portion of retained earnings. So what we're essentially saying is, yeah, we're not distributing this amount in cash or other assets. So we're going to go over the steps of a cash dividend, which I assume you will remember a little bit. We do this in Accounting 101. Let's keep in mind a few things, though. There is no legal obligation for a company to pay a dividend, right? So, I mean, there are companies that historically have paid dividends consistently, but there are other companies that have not. There is no legal obligation, unlike debt, where interest payments are contractual obligations. So we have some dates that we want to make sure we understand that are associated with paying or declaring and paying a cash dividend. A dividend does not become a liability until the board of directors votes to declare it. So at the meeting, the directors declare the cash dividend. That's the date on which the dividend becomes a liability. It's not the same date as when the dividend gets distributed, but it becomes a liability on that date. Then retained earnings is reduced because that's essentially where you get the money from, and you record your common dividends payable. Common dividends payable is typically the account we use, or dividends payable. Before the actual payment can be made, we've got to assemble a list of shareholders that are entitled to receive the dividend. So that's what we call the date of record. That's the next date. So on a specified date, we determine who owned the dividend, or who owned the stock, so that we can determine who gets the dividend. Because you guys know that you can buy and sell, buy and sell, buy and sell. It's constantly happening. And so the company has to pick a certain date on which, if you own shares of stock on this date, you get the dividend. Even if you sell the shares the next day, you still own them on that date, you get the dividend. That is called the date of record. So only registered owners of those shares of stock on that date are going to get the dividend. Okay? So to be a registered owner, you have had to purchase the shares before what they call the ex-dividend date, and that's usually just one business day before the date of record. So if you bought the shares of stock on the date of record, you're probably not going to get the dividend. You have to have owned the stock for one business day prior to that, and that's what we call the ex-dividend date. So there are two dates you got to pay attention to. These dates don't require any kind of journal entries. They're really just identifying who gets the dividend. So when on the date that the dividend is being paid, you can see up there very simply, you're going to debit retained earnings. Well, let me read the example, I guess. On June 1st, the board of directors declares a cash dividend of $2 per share on its 100 million shares, payable to shareholders of record on June 15th, to be paid on July 1st. So we've got 4 dates. We've got the declaration date on June 1st. We've got the ex-dividend date, which I just said was one business day before the date of record, so June 14th. Then June 15th is the date of record, then the payment date is July 1. So on the date of declaration, it becomes a liability. We are paying $2 per share on 100 million shares, so that's $200 million. We're leaving out all the zeros though. So that's coming out of our retained earnings. So we reduce retained earnings by debiting retained earnings. We'll credit cash dividends payable for $200 million. On June 14th and June 15th, there is no entry required. You must write no entry required, or I will mark it wrong, because leaving it blank tells me that you might not know the answer. So these are dates where you're just establishing the list of people who are going to receive the dividend, but you must write no entry. Then on July 1st, when you make the payment, you're satisfying the liability. So you're going to debit cash dividends payable, and you're going to credit cash because you're mailing out checks, or actually you're making direct deposits for $200 million. Okay, moving on. If you pay a dividend on preferred shares, and I said this in class today, which is Tuesday, though I'm making this video for Thursday, we talked about the fact that preferred shareholders are going to get their dividends first. So you're going to pay them first, right? So the shareholders equity section of Cardenas Enterprises includes the items shown below. The board of directors declared cash dividends of $360,000, $500,000, and $700,000 in its first 3 years of operation, 2026, 2027, and 2028. A little note here, the preferred shareholders are entitled to dividends of $480,000. So you can see it says preferred stock 8%, that's the dividend rate. So 8% of the $6 million in preferred stock is the amount of the dividend of $480,000. All right, so the amount of dividends to be paid to preferred and common shareholders in each of the 3 years, assuming that the preferred stock is cumulative and non-participating, which I said in class is most likely what we see with preferred stock. So you'll notice in 2026, right? Notice down here, now first of all, keep in mind, the amount that we have to distribute is $360 in 2026, right? 500 in 2027, 700 in 2028. Now, if preferred shareholders are entitled to $480,000 per year, you'll notice right away that the $360,000 cash available to distribute isn't even enough to cover the dividend to the preferred shareholders. But they get all of that $360, right? They're entitled, they get in line first, as I talked about in class. So we give them all $360. There's nothing left over to give to common, and in fact, we owed them $480, we paid them $360, so now we owe them $120 from 2026, plus we're going to have to give them in 2027 their current $480 for the year, right? So we've got nothing to the common in 2026. We get to 2027, and and there is a total of 500,000 to distribute, right? Right off the top of that 500,000, 120,000, right, comes to the, so that comes off, I'm sorry, where's the 500? So 120,000, right away goes to the preferred. That leaves me with 380,000 left to give them for their current year dividend. It's still not enough, right? We owe them 480. So we still owe them then 100,000 from 2027. So all 500,000 in 2027 is going to the preferred shareholders. And you can see the calculations are listed over here too. Nothing available to common. Now, in 2028, there's a bigger chunk to distribute. It's 700,000. You've got to remember though, we still owe the preferred, there are dividends in arrears of $100,000 plus their current 480, that's 580, right? So we have to give them 580. There was a total 700 to distribute. 700 minus 580 leaves the remainder of 120 to distribute to the common shareholders. So you can see why we say that preferred shareholders get preferential treatment. They get in line first, and if the stock is cumulative and non-participating, they get dividends in arrears. But they only ever receive their 480. They don't get any more. That's the non-participating piece. So make sure you understand that. We're going to do a practice one of those here momentarily. And just to kind of go through a couple more things here, really just to kind of give you the information. We're not really going to do any problems associated with, I might do property dividends, but we're not going to do too many problems associated with the rest of the chapter. So we have property dividends. Instead of cash dividends, you're distributing something other than cash, some other asset. It's also called a dividend in kind or a non-reciprocal transfer to owners. Non-reciprocal meaning you don't expect anything in return. Securities held as investments are the most common assets that are distributed. So instead of giving cash, we actually give somebody an investment. And those should be recorded at the fair value of the assets to be distributed, which is measured at the date of declaration, which is the date that the dividend becomes a liability. So let's take a look at an example. It makes the most sense. So on October 1st, the board of directors of Kraft Industries declares a property dividend of 2 million shares of Sing Corporation's preferred stock. Kraft had purchased the Sing shares in March as an investment. The book value was $9 million. The investment shares have a fair value of $5 per share. So $5 per share times 2 million shares is 10 million. The property dividend is payable to shareholders of record on October the 15th and distributed on November the 1st. So the first thing you see here is the October 15th, the date of declaration. Now, the first thing we have to do, and I don't know if you remember this from when we did investments in securities, back in chapter 9, we have to write up the fair value. So it says that Kraft had purchased the Sing shares in March as an investment. They have a book value of $9 million. So now they have a fair value of $10 million. So you've got to increase the value from 9 to 10. That's a $1 million difference. So this combines what we learned from chapter 12. So in order to increase the fair value of the shares to their current market value, we've got to debit investment in equity securities for $1 million, credit gain on investment for $1 million. Then we can record the liability associated with the dividend being distributed. We always take distributions for cash or for dividends out of retained earnings. So we debit retained earnings, 2 million shares at $5 per share, or a total of 10 million. And we credit not cash dividends payable, but property dividends payable for 10 million. And then we have a couple other dates to concern ourselves with. October 15th is the date of record. There's no entry. There would have been and it's not on here, the ex-dividend date would have been October the 14th. The payment date is November the 1st, so you're distributing the non-cash dividend, which essentially just means you're giving up some of your investment to someone else, right? So a debit to property dividends payable to clear out the liability because you're satisfying it, and you're reducing your investment in equity securities because you're distributing that to your shareholders. So a credit to investment in equity securities. I think we'll take a look at one of those exercises. Stock dividends, the rest of this is kind of just information. You should read through this in more detail. There are notes at the bottom of the slides. But a stock dividend is a distribution of additional shares of stock. It does not affect assets or liabilities. It simply just moves some numbers around within the shareholders' equity section of the balance sheet. Shareholders' proportional interest remains unchanged. And we tend to classify stock dividends as small or large depending on the size of the distribution. So just for an example here, it says Kraft declares and distributes a 10% common stock dividend. So 10% of 100 million shares is 10 million shares. When the market value is $1 when the market value of the dollar par common stock is $12 per share. So we will reduce retained earnings for 10 million shares times $12 per share, which is 120 million. Since we're distributing more stock, we're crediting common stock just like we would have sold it, but we're not getting cash, remember? We're distributing shares, so we're actually pulling it, it's reducing our retained earnings. We're not getting cash for it. But we credit common stock at par value, which is 10 million shares times $1 par, and I need my debits to equal my credits, so I'm off $110 million because the excess of par value is $11, right, over the $1 for a total of 12. I need to take 11 times 10 million shares to get 110 million paid in capital in excess of par. This would be considered a small stock dividend. And I'm not going to cover large stock dividends. I just wanted to give you one example of what it would look like. Stock market reaction to stock distributions. Market price per share will decline in proportion to the increase in the number of shares distributed. Early rule makers felt that shareholders were deceived by small stock dividends, believing they received a benefit equal to the market value of their additional shares, when in fact they actually do not. So consequently, the prescribed accounting treatment is to reduce retained earnings by the market value of the shares issued. And accounting for stock dividends artificially reclassifies earned capital as invested capital. In other words, I moved money out of retained earnings, which is earned capital, and I moved it into common stock paid in capital in excess of par, which is invested capital. So as I said earlier, a stock dividend just rearranges the balances of some accounts within the stockholders' equity section of the balance sheet. Some reasons for stock dividends. Companies try to give shareholders the illusion that they are actually receiving something like a dividend, and it does enable the corporation to take advantage of the accepted accounting practice of capitalizing retained earnings. Capitalizing retained earnings, again, in this case, I know we talk about capitalize meaning to record as an asset, but here all it means is that we're essentially doing what this says here, reclassifying earned capital as invested capital. It makes the company look like they have more investment money than they actually do. That's what they mean by capitalizing. Stock splits. A stock split is exactly what it sounds like. We take, and actually the purpose of this is to reduce the market price so it makes it more affordable. But you literally take a share of stock and you split it into like 2 or 4 or 10 or whatever the split is. So again, the objective is to induce the per share market price to decline, and the motivation for reducing the market price is to increase the marketability, to make it more attractive to a larger number of potential investors, to make it more affordable. So for example, if a company's share price is $100, and it might decide to issue a 100% stock dividend, which is a 2-for-1 split, so that holders of one original share end up with 2 shares after the split. The new share price would be $50 per share. So 50 times 2 is 100, right? It still equals the same total value, but you're making it more affordable. $50 is more affordable than 100. If a large stock distribution is accounted for as a stock split, no journal entry is made. So a stock distribution can look like a stock split. Since the total par represents twice as many shares in a 2-for-1 stock split, the par value will be reduced by 1/2. All records that refer to the previous amount must be changed to reflect the new amount. To avoid changing the par value, a company can refer to the stock distribution as a stock split effected in the form of a stock dividend because they might not want to change that par value. And in that case, you do need a journal entry which increases the common stock account by the par value of the additional shares. I'm not going to have you guys do any of that, but you can certainly look at an example in your book. So here's just an example of a stock split effected in the form of a stock dividend, aka a large stock dividend. So it says Kraft declares and distributes a 2-for-1 stock split effected in the form of 100% stock dividend, which is 100 million shares, when the market value of the $1 par common stock is $12 per share. So you can do this one of two ways. You can simply just take the 100 million shares at $1 par, move it out of paid-in capital in excess of par and move it into common stock, or you can debit retained earnings, reduce retained earnings, and move it into common stock. Either way, again, you're moving a portion just from one account in stockholders' equity into another account. You're not changing the total stockholders' equity value. You're changing the individual balances of some of the accounts. So the impact here, you'll reduce the paid-in capital in excess of par, so you'll have less to distribute, but you'll increase your what perceives to be an investment amount. Here you'll reduce retained earnings and increase common stock, thereby increasing the investment amount. You can reverse stock splits, so companies can decrease their outstanding shares. No journal entry was necessary. Theoretically, the market price should increase, and this is often done to try to increase the stock price when companies are struggling. So for example, a 1-for-4 reverse stock split, 100 million shares, $1 par, would become 25 million shares, right? So divide by 4, it's 25, but at $4 per share, because 100 million times $1 is $100 million, 25 million times $4 is still $100 million. You're just trying to make less shares available. You can do fractional shares. This kind of gets into, obviously, it doesn't have to be a whole share. You can do fractional shares. This is just an example here. If you do something like a 5-for-4 stock split, then you're going to have to kind of figure out how that's going to work. And again, this is an example here. A company declares a 25% stock dividend, or equivalently a 5-for-1 stock split. A shareholder owning 15 shares would be entitled to 3 3/4 shares. Typically, a stock dividend or split results in some shareholders being entitled to fractions of whole shares. And that's just because of the math, right? I mean, not everything divides, multiplies, or divides evenly. So if the market price is $12 per share, the shareholder would receive 3 additional shares and $9 in cash. So in other words, 12 times 3/4. All right, so that's it for the chapter. Let me jump over here while in the same video. Just going to switch over to my doc reader here, and we're going to take a look at just a couple more brief exercises to wrap this up. And I actually think I'm only going to do 1 or 2 here. So let's take a look at brief exercise 18-10, still on the same page, page 1084. Okay, it says, Philadelphia, October 26, 2023, Business Wire, Comcast Corp. Announced that its board of directors declared a quarterly dividend of 29 cents a share on the company's common stock. The quarterly dividend is payable on January 24th to shareholders of record at the close of business on January 3rd. It says prepare the journal entries Comcast used to record the declaration and payment of the dividend for its 4 billion shares. So, on the date of declaration, right? And it says that October 26th was the announcement. I'm not exactly sure when the date of declaration was. It's probably a day before that, but we'll just pretend like it's October 26th of 23. And this would be the declaration date. So the declaration date, just to make sure you're clear here, this is where we debit retained earnings and we credit cash dividends payable. That's what this is. And the amount is going to be, it'd be helpful if you could see it, huh? The amount's going to be there are 4 billion shares, right? 4 billion shares at 29 cents a share. So make sure you plug this into your calculator to make sure you're getting the right answer, but it should be 1,160,000,000. So 1,160,000,000, right? 1,160,000,000. And I guess I should probably write that as a B, and I'm going to put up here instead, I'm going to put in millions, because that makes more sense doing it this way. So this is 1,160,000,000, okay? Then the date of record, it says in the problem, it said the date of record was January 3rd, which tells me that January 2nd is the ex-dividend date. Okay, you must write no entry, or I'm marking it wrong. January 3rd is the date of record. Again, no entry, you must write that. Blank doesn't tell me you know the answer. And then on the payment date, of course you'd think I'd remember that. The payment date was January 24th. So on January 24th, all we're doing is we're satisfying now the payable. So we're going to debit cash dividends payable. And we're going to credit cash for 1,160,000,000. Okay? I don't need all those zeros unless you need them to make sure it's clear for you. So that is, let me back out of that just a little bit. There we go. That is brief exercise 1810. Okay, moving on. We're going to do 11, because I think this is kind of important. I don't know if I want to write on the back of that page. Okay, brief exercise 11. This is specifically, let me zoom in here a little bit. It says the shareholders' equity of MLS Enterprises includes 200 million of no par common stock, 400 million of 6% cumulative preferred stock. The board of directors declared cash dividends of $50 million in 2027 after paying 20 million cash dividends in 2026 and 2025. What is the amount of dividends the shareholders will receive in 2027? So basically, we've got to set this up similarly to the way it was presented in the PowerPoints that I just went through. So we're looking at preferred, common, 2025, 2026, 2027, okay? Now, the first thing I need to figure out is how much are the preferred shareholders getting, right? So preferred shareholders, according to this, there's a 6% cumulative, so 6% is the dividend rate, and they're getting 6% of the 400 million. So they are entitled to receive a $24 million dividend every year before anyone else gets anything. Okay? So in 2025 and 2026, the amount that was available to distribute was 20 million. All right, so 20 million, 20 million, and then in 2027, 50 million, sorry, I had to think about that for a second. All right, or find that, I should say. Okay, so how does this work out here? Well, if preferred are supposed to get 24 and there was only 20 to distribute, then preferred's getting all 20 and common's getting nothing, right? Now, I like to kind of keep a running total somewhere if you want to. So we still owe from 2025, oh, don't blank out on me now. We still owe the preferred another 4, right? So we still owe them 4 here from 2025. We owe them another 24 in 2026, but we only have 20 to distribute. So that's 20 there, and again, 0 for common. So now at this point, right, you owe them 4 here and you owe them 4 here, which is a total of 8. So now in 2027, you owe them 8, plus you owe them the 24 for the current year. So you owe them a total of 32. So in 2027, we give them 32. There was 50 to distribute. The other 18 million gets distributed to the common. So there are a couple of different ways you can approach this, but that's kind of how I do it. I like to kind of write, okay, what did we still owe them? The sum of what we owed them in that last year was still 8 plus the current year of 24. So they get 32 of the 50. Common gets the rest of that in that year. Okay, and let's see here. We'll do one more. We'll do exercise 1812, that property dividend there. Alves Moving and Storage, family-owned corporation, declared a property dividend of 1,000 shares of PayPal common stock that Alves had purchased in February for $56,000 as an investment. PayPal shares had a market value of $52 per share on the declaration date. Prepare the journal entries to record the property dividend on the declaration and payment dates. All right, so let's see here. All right, well, on the date of declaration, first thing is first, right? We have a loss here. It says they had purchased the investment for $56,000, right? 1,000 shares at $56,000, so they obviously paid $56 per share. But now the market price is only $52 per share. So that's a $4 per share loss, right? So on the declaration date, the first thing we have to do is we have to adjust the investment to its fair value. So this is a loss. So we have loss on investment, and I'm keeping it simple. And you could just kind of look at it this way. We went from 56, right, to 52. 56,000 was what was paid. 52 is times 1,000 is the current value. So we want to decrease the account investment in equity securities, which I know we didn't really cover equity securities a lot, but or at all even, but this is very similar to the way we approach the other investments, so it's all good. So now we've reduced that to its fair market value, and now we record the liability. So we debit retained earnings, and this is 1,000 shares at $52 a share, so 52,000, and we credit property dividends payable. For 52,000, okay? And that's the date of declaration. Then on the payment date, which is the only other date we really have here for now, obviously ignoring some of those other dates in between which don't require a journal entry, we're simply satisfying the liability, so we're going to debit property dividends payable. And think about this, we're distributing that investment in equity to security, so we want to reduce it because we're giving it away. And let me back out of here just real quick so we can see the whole thing. And that is a wrap for chapter 18. So if you have questions now, that's certainly not all of the brief exercises that we could have done, but it's all that I'm doing for now. It's enough to get you kind of going with your homework, which will be in Canvas. I'll post in Canvas. If you have questions, reach out. I will be checking email periodically, and I'll get back to you as quickly as I can. Thanks, guys.